Something changed. Not once, 6 times. And every single one of those changes is already affecting the amount of money landing in your bank account, the amount of tax being taken out of your check, the age at which you can collect your full benefit, and the rules that govern how much you are allowed to earn before the government starts cutting your payment. 6 changes, all of them live, all of them already in effect. And based on what I am hearing from clients across this country, the overwhelming majority of retirees collecting Social Security right now do not know about a single one of them. This is not a warning about something that might happen next year. This is a warning about something that has already happened. It happened in January. It happened in the Law Congress, signed in 2025. It happened in the Social Security Administration's own payment calculations that went into effect with your first check of 2026. Some of these changes put money back in your pocket that you are not collecting. Some of them are taking money out of your pocket in ways you have not noticed. And one of them, the one I am going to tell you about last, is the most important change to Social Security in more than a decade. And most of the people it was designed to help have not received a single dollar from it yet because the agency responsible for processing it is running months behind. Change number 1 is the one that put money in your pocket in January and then quietly took a significant portion of it back in the same month. In January of 2026, every Social Security recipient received a 2.8% cost of living adjustment. For the average retired worker, that meant roughly $56 more per month. For a retired couple, the combined increase was about $88 per month. The COLA was applied automatically. You did not have to do anything to receive it. What the Social Security Administration did not explain clearly in the notice it sent you was what was happening on the other side of the ledger at the exact same time. Medicare Part B premiums increased by 9.7% in 2026. The standard premium went from $185 per month to $202.90 per month. That is an increase of $17.90 per month. For most retirees, that Medicare premium is deducted directly from their Social Security check before it is deposited, which means the math looks like this. Your Social Security went up $56, your Medicare deduction went up $18, your net increase was approximately $38 per month, not $56. And for retirees who are subject to the IRMA surcharge, the income-related Medicare premium addition I have covered in a previous video, the Medicare increase was even larger. At some income tiers, the total Medicare premium increase in 2026 consumed the entire Social Security COLA and more, meaning some retirees received a cost of living adjustment this year that resulted in a smaller net deposit than the year before. Your COLA was real, your Medicare increase was real, nobody put them side by side in the notice they sent you. That is change number 1. Change number 2 is the full retirement age update that permanently affects everyone born in 1960 or later, and it is the change that is costing people who do not know about it the most money right now. Full retirement age is the age at which you can collect your complete, unreduced Social Security benefit. For years, the full retirement age was 66 or 66, and a specific number of months depending on your birth year. In 2026, that transition is complete. Every American born in 1960 or later now has a full retirement age of 67. That sounds like a minor administrative detail. It is not. Here's what it actually means in dollars. If you claim Social Security at 62, the earliest possible age, your monthly benefit is permanently reduced. The reduction is calculated as a percentage of the difference between 62 and your full retirement age. When full retirement age was 66, claiming at 62 meant a 30% permanent reduction. Now that full retirement age is 67, claiming at 62 means a permanent reduction of approximately 30%. And here is the number that most people do not know. Every year you wait beyond 62 and up to age 70, your benefit increases. Between full retirement age and 70, the benefit grows by 8% per year. That is a guaranteed 8% annual increase on the base benefit for every year of delay. A retiree born in 1960 with a full retirement age, benefit of $2,000 per month, collects $1,400 per month if they claim at 62. The same person collecting at 70 receives $2,640 per month. The difference is $1,240 every single month for the rest of their life. Most retirees I work with have run a break-even calculation at some point and concluded that claiming early makes sense. What most of them have never run is a survivor calculation. When one spouse dies, the surviving spouse keeps the higher of the two benefit amounts. If the higher earning spouse claimed early and locked in a permanently reduced benefit, the survivor lives on that reduced amount for potentially decades. The claiming decision is not just about the person claiming, it is about the surviving spouse who will live on that decision for the rest of their life. That is change number 2. Change number 3 is the earnings limit update, and this one is specifically for the retiree. who is still working while collecting Social Security and who may not realize that the rules around how much they can earn just changed. If you are collecting Social Security benefits before your full retirement age and you are still working, the Social Security Administration applies what is called the Retirement Earnings Test. If your earnings exceed a certain annual threshold, the agency withholds a portion of your benefits. $1 in benefits is withheld for every $2 you earn above the threshold. In 2026, the earnings threshold is $24,480 per year. That is $1,240 less than you could earn in 2025 before the withholding kicked in. The threshold moved in the wrong direction from the perspective of working retirees. But here is the part that almost nobody explains. The withheld benefits are not lost. When you reach full retirement age, the Social Security Administration recalculates your benefit to credit you for the months your benefits were reduced or withheld due to the earnings test. Your monthly benefit going forward is permanently increased to account for the withholding period. The money you did not receive during the earnings test years comes back to you in the form of a higher monthly payment for the rest of your retirement. Most working retirees either do not know the earnings test applies to them and are surprised when benefits are reduced, or they do know it applies and they believe the withheld money is simply gone. Both groups are operating on incomplete information. Understanding the test, the threshold, and the recalculation that follows full retirement age changes how you make decisions about working income in the years before your full retirement age. That is change number 3. Change number 4 is the one that put real money on the table for millions of retirees, and that most of them still have not collected. The One Big Beautiful Bill Act, signed into law in 2025, included a new $6,000 deduction, specifically for taxpayers 65 and older. For married couples where both spouses are 65 or older, the deduction is $12,000. It applies to your 2025 tax return filed in 2026 and to subsequent returns through 2028. This deduction does not replace anything you already receive. It stacks on top of your regular standard deduction and on top of the existing extra deduction seniors receive for being over 65. It reduces your taxable income by $6,000 additional dollars, and it reduces the amount of your Social Security that is subject to federal income tax. The income thresholds are broader than most people assume. A single filer qualifies for the full deduction with income up to $75,000. A married couple qualifies up to $150,000. The deduction phases out gradually above those thresholds and does not fully disappear until income exceeds $175,000 for a single filer or $250,000 for a married couple. For the lower income retiree, this deduction stacked on top of everything else very likely pushes their federal income tax to zero. For the comfortable middle-class retiree with income comfortably within the threshold, a $12,000 deduction at the 22% bracket is $2,640 back in their pocket this year. And here is what makes this change urgent rather than simply interesting. The deduction expires after tax year 2028. It is not permanent. It exists for 4 years, and then it is gone unless Congress extends it. Every year you fail to claim it is a year you cannot recover. If you already filed your 2025 return and your preparer did not apply this deduction, you can file an amended return within 3 years to claim it. If you have not filed yet, make sure the deduction is being applied. And if you will be filing next year, put a note where you will see it. That is change number 4. Change number 5 is the windfall elimination provision repeal. And this is the change that the Social Security Administration has been processing for over a year, and that has still not reached millions of the retirees who are entitled to benefit from it. The Social Security Fairness Act, signed on January 5th of 2025, eliminated 2 rules that had been quietly reducing Social Security benefits for certain public sector workers for decades. The first rule was called the windfall elimination provision. The second was called the government pension offset. Here is who those rules affected. If you worked in a job that did not pay into Social Security, such as many state and local government positions, certain school district jobs, federal civil service jobs from before 1984, or similar public sector roles, and you also earned a Social Security benefit from other work during your career, the windfall elimination provision was reducing your Social Security benefit. In some cases, by several $100s per month. In some cases, by more. The government pension offset affected spousal and survivor benefits. If you received a pension from a non-Social Security covered job and you were entitled to Social Security spousal or survivor benefits based on your spouse's record, the government pension offset was reducing, or in many cases, eliminating those benefits entirely, completely eliminating a spousal benefit that a surviving spouse had expected to receive after a marriage of 30 or 40 years. Both of those provisions are now gone, eliminated. and the Social Security Administration is required to recalculate the benefits of every affected retiree and pay retroactive amounts going back to January of 2025. The agency has processed a large number of these recalculations. It has not processed all of them. The backlog is significant. The SSA lost more than 7,000 employees in 2025, and the volume of WEP and GPO cases requiring individual review and recalculation has overwhelmed the remaining staff. Some affected retirees have received their increased benefit and their retroactive payment. Others are still waiting. Others do not know they are entitled to anything because nobody has contacted them. If you or your spouse spent any portion of your career in a public sector job with a pension that did not pay into Social Security, and if your Social Security benefit was reduced or your spousal benefit was affected, log into your MySSA account at ssa.gov and review your current benefit amount. Compare it to what you were receiving before January of 2025. If the amount has not increased and you believe you were affected by the WEP or GPO, call the Social Security Administration directly and ask about the status of your recalculation. The retroactive payment, in some cases, represents months of missed benefit increases. It will not be paid automatically without the agency completing your individual case. Following up directly is how you find out where your case stands. That is change number 5. Change number 6 is the trust fund projection update. And I'm including it not because it changes anything you do right now, but because it is the context that makes every other decision on this list more urgent. The Social Security Trustees Report published in June of 2025 projected that the Social Security Trust Fund will be depleted in 2033. 7 years from now. If depletion occurs without congressional action, the program would be able to pay approximately 79% of scheduled benefits from ongoing payroll tax revenue. Not zero, not a complete collapse, but a 21% automatic reduction in every retiree's monthly check. 2 things happened in 2025 that brought that date closer. The Social Security Fairness Act expanded benefits for millions of public sector workers, increasing the program's obligations. And the new senior bonus deduction reduced the federal income tax revenue that indirectly flows back into the broader federal budget. Together, those changes accelerated the projected depletion date by roughly 1 year compared to the prior trustees' report. I am not telling you this to alarm you. I am telling you this because it is the backdrop against which every Social Security claiming decision, every tax planning decision, and every retirement income strategy should be made right now. Congress has always acted before a depletion scenario becomes real. They may act again, but the people who are most insulated from any future adjustment are the ones who claimed at the highest possible benefit level, who have diversified income sources beyond Social Security alone, and who have built the kind of retirement income structure that does not depend entirely on the program remaining unchanged. That is change number 6. Now let me tell you what to do, because the purpose of this video is not to leave you with a list of changes and no direction. It is to give you the specific moves that respond to each one. For change number 1, the COLA and Medicare interaction, pull your most recent Social Security deposit and compare it to what you expected based on your COLA notice. If the net increase looks smaller than the announced COLA percentage, calculate your new Medicare deduction and confirm the math adds up. If you are subject to IRMA and your income situation has changed since the return Medicare is basing your surcharge on, the SSA 44 appeal form is available at ssa.gov for change number 2, the full retirement age update. If you are within 10 years of retirement and have not run the detailed break-even analysis that accounts for your health, your spouse's benefit, and the survivor benefit calculation, do it before you claim. The decision you make on the day you file is permanent. Getting it wrong by 2 years in either direction can cost or save more money over a 30-year retirement than almost any other financial decision you will make. For change number 3, the earnings limit. If you are working while collecting benefits before full retirement age, know the $24,480 threshold, and know that benefits withheld due to the earnings test are credited back to you after full retirement age. Do not make work decisions based on a fear of losing benefits permanently. The withholding is temporary. The recalculation is guaranteed. For change number 4, the senior bonus deduction, claim it. On your 2025 return being filed now, on your 2026 return being filed next year, on your 2027 and 2028 returns, every year until it expires or Congress makes it permanent. $6,000 per person, $12,000 for a married couple where both are 65 or older. It is in the law. It is available right now. Do not leave it on the table. For change number 5, the WEP and GPO repeal. If you spent any part of your career in a public sector job, verify your benefit amount in your MySSA account and call the agency if you believe your recalculation has not been completed. The retroactive payment you may be owed will not arrive automatically until the agency processes your individual case. Following up is not aggressive. It is the only way to know where you stand. For change number 6, the trust fund timeline, diversify your retirement income sources to the extent your situation allows. Social Security is the foundation. It should not be the entire structure. Maximizing your benefit through the right claiming strategy, building a small investment or savings buffer, and understanding the tax moves that reduce your effective cost of living in retirement are all part of building the insulation that makes a future congressional adjustment less catastrophic. Before I close, I want to give you something to take with you. I put together a free checklist, my 2026 Social Security Changes Checklist. It covers all 6 changes I described today with specific action steps for each one: the COLA and Medicare net change calculation worksheet, the full retirement age claiming comparison table, the earnings test threshold and recalculation explanation, the senior bonus deduction income limits and how to confirm it was applied on your return, the WEP and GPO repeal verification steps, and the SSA contact protocol, and the trust fund context and the 5 diversification moves that provide the most protection on a fixed income. Every item includes the form number or phone number where action is required. To get it, go to marcusgravestacks.com/checklist. The link is also in the description. Print it out and go through it this week. Because 6 changes are already in effect, and the retirees who respond to them correctly will collect more money, pay less tax, and carry less risk than the ones who find out about these changes 2 years from now when the gap between what they received and what they were entitled to has already grown. Here is what I want to leave you with. 6 changes to the most important financial program in most retirees' lives happened in 2026. Some of them added money, some of them took it back. One of them created a benefit increase for millions of public sector retirees that the agency responsible for paying it is still catching up to. None of them were announced in plain English in a way that the average retiree receiving a payment every month could act on immediately. That is not an accident. It is the nature of a program this large, administered by an agency, this understaffed, communicating to an audience this large. The changes happen. The notices go out. Most of them go unread or misunderstood. The money sits in the gap between what changed and what most people know. You now know what changed. You have the action steps. The gap closes when you act. Send this video to one person in your life who collects Social Security. A parent, a neighbor, a sibling, a friend from church. The odds are very good that at least one of these 6 changes is affecting their check right now, and they have no idea why. One share from you today could be worth real money to someone who needed this information months ago. That is what this channel is here to do. I will see you in the next one.